Good morning, ladies and gentlemen. I am Eugene from SIAS. Thank you for joining us at Corporate Connect this afternoon. This webinar is organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, market strategist from SGX, to share with us on market updates, followed by a presentation by Mr. Robert Wallace, CEO of Frasers Logistics Commercial Trust. And we will end off with a Q&A session moderated by Mr. Benjamin Goh, Head of Research and Investor Educations from SIAS. Without further ado, let us welcome our first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Thank you very much, Eugene. Very good afternoon to everybody. I'm the SGX market strategist and intend to provide a quick update over the next 15 minutes or so on some of the current drivers of our Singapore stock and REIT market. We must point out that the presentation is designed to be purely informative from my half, with recent observations in the moves of the stock market, and in no way is providing investment advice. So in the 2021 year so far, we have the Straits Times Index, the third strongest performing benchmark across Asia, with India's Nifty and Taiwan's TAIEX taking the lead. The STI has generated an 11% price gain, with reinvested dividends boosting that total return to 14%. And while the trio of DBS, OCBC and UOB make up 20% of the total market cap of all stocks listed on Singapore Exchange, in addition to 20% of the day-to-day turnover, the three banks do make up more than 40% of the STI. And so far this year, the three banks have averaged more than 20% total returns, which has been very closely aligned with global benchmarks for the global banks. Globally, banks have been supported by resilient investment activity across the world and a generally steeper yield curve, which has supported those banks that obviously borrow short and lend long. In the meantime, the 7 REITs that are part of the STI have averaged around 4% total returns in the year thus far, with Frasers Logistics Commercial Trust leading the 7 in the 2021 year through to the 16th of August with a 12% total return. One key cross market that impacts both the global banks and the global REITs is the US 10-year bond market. And since the 8th of June, when 10-year yields ended their New York session at a fresh 12-week low, the US yield curve has flattened from around 138 basis points to 105 basis points. And this has seen REITs globally outpace the banks since the 8th of June, with global bank indices down around 2% and REIT indices up 4%. This rotation has extended into the STI as well, with the 7 REITs averaging 3% price returns from the 8th of June, while the 3 banks, DBS, OCBC and UOB, averaged a 1% decline in price. And institutions were net sellers of the 3 banks, with combined net inflow of more than $500 million since the 8th of June, and they were net buyers of the 3 industrial REITs listed in the STI, which more than offset the net selling of the remaining 4 REITs. So since the conclusion of not the most recent, but the 16th of June FOMC, the Federal Reserve Open Market Committee meeting, there's been an increased focus on commentary by Fed officials on their opinions on tapering and when to start tightening interest rates. And while the Fed chair has noted individual opinions don't form an FOMC decision, the officials have been encouraged to share their opinions on tapering for the good of transparency. And what this means is that the 30-day volatility of the US yield curve, the 2 to 10 yield curve, has almost doubled since the 8th of June, with both downward and upward daily swings providing bigger trading ranges that have suited the active portfolio managers, particularly in the financial sectors, such as the banks, and the adjacent sectors to financials, such as real estate. So in the STI, the 5 strongest STI stocks for this third quarter to date, they include CapitaLand, Singtel, as well as Ascendus REIT and Frasers Logistics Commercial REIT, while the 4 Jardine Constituents and Semcorp Industries have led the decliners over the past 6 to 7 weeks. So while the STI is up around 2% in the quarter to date, the performance differential of the top and least performing stock in the STI is almost as much as 30%. But back to this chart with the blue line showing the return of the STI, the price return, and then the green line representing the return of the IHS REIT index. You can see that over the 3 years, the price performance of the STI has been less than the IHS REIT index, but not by much. But what the dividends have done is the STI basically declined 2% in price, with dividends taking the total return to 10% over the 3 years, while the IHS REIT index gained 12% in price, with reinvested dividends taking the total return to 32%. Now, as of yesterday, the STI would have to gain another 16%, that's 16%, to return back to its May 2018 3640 high, while the IHS REIT index would have to rally some 10% to return to its Feb 2020 all-time high. The IHS REIT index, it's comprised of something less than 40, it's 37 constituents, and they are presently trading at a 26% weighted average premium to book value, which is down from a 33% premium to book value when the index traded at its all-time high on the 20th of Feb 2020. However, the median PB of the 37 constituents is around at an 8% discount to book value, which is off the median 5% premium observed back on the 20th of Feb 2020. But it's very much aligned with the region. If you exclude the United States, global REITs are trading presently at a marginal discount to book value and off the similar 5% premium that they were trading at in Feb 2020. So I'll try and move on as quick as I can. But for the past 19 years, just to run through our history of the REIT market here in Singapore, since that 2002, we have grown to be one of Asia's largest REIT and property trust markets. We now list 33 real estate investment trusts for trading, in addition to 5 staple trusts and 2 business trusts that are investing in property. As of the end of July, the combined market value of the S-REIT sector stood at 114 billion Singapore dollars, which represented 13% of the combined value of all stocks listed for trading on our exchange. And our S-REIT sector is recognised as a regional and more of as like a global REIT hub. As many as 16 of the trusts listed here, as many of 16 of these REITs and property trusts, I should say, they exclusively invest in property assets outside of Singapore, with 19 of the trusts investing in properties in both Singapore and outside Singapore, and the remaining 5 REITs investing purely in Singapore. And it includes as many as 10 trusts with properties in China, 7 REITs with properties in Japan, 6 REITs with properties in Malaysia. The trusts are also highly diversified across property types, with a balance across retail, industrial, office, and hospitality properties, in addition to multiple REITs investing in healthcare-related properties and specialised REITs such as data centres. Exemplifying this diversification, the portfolio of Frasers Logistics and Commercial Trust, it spans more than 100 properties that are comprised of logistics and industrial properties, office and business parks, and CBD commercial buildings across as many as 5 countries, including Australia, Australia, Germany, Singapore, Netherlands, and the United Kingdom. And just to clear that up, Mr. Wallace will be presenting very soon after me. So it's 5 countries: Australia, Germany, Singapore, Netherlands, and the United Kingdom. The combined market value of the S-REIT sector, it has grown at an 11% compound annual growth rate over the past 10 years. And it's not just down to performance, but portfolio growth through acquisitions that, among many methods such as debt, can be funded through secondary fundraisings and such as placements and rights issues. In the first 7 months of 2021, we saw S-REITs announce asset acquisitions that exceeded 7.5 billion Singapore dollars in total purchase consideration. Several acquisitions announced during the period were in assets such as data centers, logistic warehouses, and office buildings. In addition, the majority of the acquisitions that were announced were outside of Singapore, further entrenching our position as a global REIT hub. Recent examples of acquisitions include the manager of Keppel DC REIT announcing its first data center acquisition in China back on the 26th of July. 2 days later, the manager of Keppel Pacific Oak US REIT announced it had entered into 2 purchase agreements to acquire 2 office buildings in the United States. Both REITs are expected to complete those acquisitions this quarter, with acquisitions also expected to be distribution per unit or DPU accretive. On 13th of August, the manager of Mapletree Logistics Trust proposed an acquisition of a storage facility mostly comprised of cold and freezer warehouses located in the inner west precinct of Melbourne, and that will be 100% funded through debt. And then I think on the 4th of August, Cromwell European REIT also announced it was accelerating its pivot into logistics with its first freehold acquisition in the UK. So globally, industrial REITs have posted both median gains in both 2020 and the 2021 year to date, with warehouse, business parks, and logistic efficiency supported, of course, by the growth of e-commerce, technology, and consumer good industries, not to mention resilient trade growth. Industrial REITs, they can play an important role in industrial and manufacturing supply chains as well. And as we know in Singapore, manufacturing has been comparatively resilient over the past 12 to 18 months. And that has, of course, been supported by the rising Asian middle class and the increasingly consumer-driven economy, which has urbanization, advances in technology, and that e-commerce obviously deepening regional supply chains as well. The IHS REIT Index year-to-date return of 7%. It has been led by healthcare REITs, industrial REITs, and office REITs. And as shown in the bar chart here, office REITs and industrial REITs also maintained the highest 12-month trailing distribution yields as of the 30th of July. And with the conclusion of the June quarter earnings seasons, overall, the combined DPU of the S-REIT sector over the past 12 months is up marginally from the preceding 12 months. The REITs and property trusts listed here in Singapore average a trailing 12-month dividend yield of 5.8%. And this compares to a median yield of 4.4% for the close to 300 REITs listed across Asia Pacific, and a median yield of 4.0% for the more than 800 REITs that are traded across the world with a combined market value of $2.4 trillion US dollars. The 3 REIT ETF that we had, the 3 REIT ETFs that we have listed in Singapore, they were listed in a fairly quick time frame of 12 months back between 2016 and 2017. They include the Nikko AM Straits Trading Asia ex-Japan REIT ETF, the Lion Phillip S-REIT ETF, and the Phillip APAC Dividend REIT Leader ETF. The 3 REIT-focused ETFs, they have a combined asset under management of more than 600 million Singapore dollars, and the 3 REIT ETF-focused, ETFs have recorded combined inflows of more than 130 million Sing dollars in the year to date. So Singapore first listed its first ETF 19 years ago back in May 2001, and gradually the combined assets under management of this ETF suite listed here, it climbed to $5 billion in August 2019. And just 2 years later, the combined AUM has reached another milestone, doubling to 10 billion Singapore dollars. And the REIT ETFs have played a role in this AUM growth. The Nikko AM Straits Trading Asia ex-Japan ETF was among the 5 ETFs listed here that have been among our 5 Singapore-listed ETFs recipient to the most inflows in the 2021 year to date. So I'll finish off here, but I should just mention with last week, representing, I guess, the heaviest week for earnings that we've had since the month of May. The reactions, the rotations, and the rebalancing, it may, while we do take these cues from the recent earnings and outlooks, they will also be taking cues from regional progress, obviously, in containing COVID-19 breakouts, signal from Fed officials on tapering and rates, which, as we said from the outset, do impact the financial and the financial adjacent sectors such as real estate. And of course, the race to vaccinate also continues, with Asia administrating its 3 billionth COVID-19 vaccine dose back on Thursday last week. For more information on not just the REITs and the banks and so forth, on the ETFs, but of all the products and sectors across our market, we do have our recently launched Telegram channel, colloquially called SGX Invest, and we encourage you to find us there. And we also, if you do prefer once in a week emails, our SGX My Gateway, it has been running for a good 9, coming up to 10 years now, and does have a very wide subscriber reach. So if you're not already receiving the My Gateway report or subscribe to Telegram, please don't hesitate to let us know or to see if we can help you any further with education, insights, and information. All right, so I'll finish off here, and I look forward to muting myself and listening to Mr. Rob Wallace talk for Frasers Logistics and Commercial Trust. Thank you so much.
Thank you, Geoff, for sharing. And next, we are pleased to welcome the representative of Frasers Logistics and Commercial Trust, Mr. Robert Wallace, Chief Executive Officer, Ms. Susanna Sher, Chief Financial Officer, and Tricia Yeo, Head of Capital Markets and Treasury. They will share with us more about the company. Ladies and gentlemen, please.
Thanks, Eugene, and thanks everyone for making the time to attend our presentation. And thanks, Geoff, for a very informative presentation as well. Certainly is an interesting time for investment. For those of you who are not familiar with Frasers Logistics and Commercial Trust, we've been around for just over 5 years now. We listed on the SGX on the 20th of June 2016, and we have now grown to have 103 properties across 5 countries. Our portfolio value is just under 7 billion Singapore dollars in size. It's a well-occupied portfolio of 96.3% occupancy rate and a good healthy WALE of 4.9 years. Importantly, from a sustainability viewpoint, it's a key consideration when we come to investing and managing our portfolio. And under GRESB, which is the Global Real Estate Sustainability Benchmark, we've been named Global Sector Leader for 3 consecutive years for our industrial portfolio. So this slide just gives you a quick snapshot of our portfolio, where our assets are and what asset type they are as well. You can see that Australia is the bulk of the portfolio. We've got 62 properties in Australia, and 59 of those 62 are actually industrial properties. The portfolio value is just under 3 billion in size. We've got 2 CBD commercial properties, one in Melbourne at 357 Collins Street, and a 50% stake of another building in Perth, being Central Park. It's actually Perth's tallest building. We also have a business park in Canberra, which is at 100% leased to the Australian government. In Germany, it's our second largest market. We have 29 industrial properties, just over 1.5 billion Sing dollars in value. And in Singapore, we have 2 commercial properties. One, a CBD fringe property known as Cross Street Exchange, as well as a business park called Alexandra Technopark. In the UK, we have 1 recently acquired logistics asset, as well as 3 business parks. We acquired one of those recently as well. And finally, in the Netherlands, we have 6 properties, just over 300 million Sing in value, and they are all logistics properties as well. So on to the next slide. I spoke about our growth, and yes, we listed on the 20th of June 2016 with 51 properties and 3 call option assets. We actually called those options and grew to 54 at that time. over the years, you can see that we've grown through a number of acquisitions. The bulk of our acquisitions have actually been from our sponsor, being Frasers Property Limited. However, this year we did announce our maiden first third-party acquisition, being both a business park as well as a logistics facility just outside of Birmingham in the UK. We've been quite an active portfolio manager. We are quite keen to keep our portfolio relevant, and over that period of time, we've sold about 460 million Sing worth of assets, fortunately all at premiums to book value. And importantly, in FY20, we announced the merger with Frasers Commercial Trust, which certainly grew us to quite a large portfolio of 6.2 billion AUM and introduced commercial assets into our portfolio. I did mention our most recent acquisition. That was actually in total 6 European properties. There were 4 industrial properties in continental Europe, 3 of those in Germany and 1 in the Netherlands. And that was actually funded in part by a private placement, which was priced at the top end of the price range. And we raised about 335.8 million Sing dollars. I won't talk too much about our trading performance. I think Geoff's spoken at length about that, other than to say we closed on the 13th of August at $1.52. And certainly that's up from where we were 12 months ago, which was $1.35. And you can see here now we are the 6th largest REIT with a market cap of around about 5.6 billion Sing dollars. On average, we're trading at around about 10.5 million units per day. Our yield is still attractive at around about 5%, and our unit prices increased by about 12.6% over that time. Looking at some of the key index memberships, we are a constituent of the FTSE EPRA Nareit Global Developed Index. We have been since March 2019. And more recently, we're included as a constituent stock of the benchmark Straits Times Index. That was done in the 13th of April 2021. In the bottom left-hand corner, if we just go back to that slide, you can see our trading yield compared to a number of other measures. You can see it actually measures up quite well comparatively. So I did talk a little bit about sustainability. As I said, it's an important aspect that we look at FLCT. We've got a number of key accolades, as I spoke about in relation to GRESB. In relation to Green Star, which is a rating tool in Australia, we've actually got the highest Green Star performance rated industrial portfolio in Australia. And we had a number of firsts as well. We had the first 6-star Green Star rated industrial properties in the states of New South Wales, Victoria and Queensland. They are Australia's 3 most populous states. And also Neighbours, which is another rating tool. That's a rating tool for commercial properties. Both 357 Collins Street and Caroline Chisholm Centre in Canberra have minimum 5-star ratings. And in fact, Central Park is the first commercial building in Australia to achieve a 4.5-star Neighbours base building rating as well. We have some good ratings from a BREEAM perspective as well, which is a UK measurement. But from a sustainability viewpoint, we see the benefits from this. We have established a sustainable finance framework just last month. And in fact, we have raised about 1.4 billion in green and sustainability linked financing since our IPO. In fact, just last month, we did our maiden sustainability notes issuance and raised 150 million Sing dollars at that time. So moving on to the performance highlights for our third quarter. Team was quite active. We undertook about 75,000 square metres of leasing in that quarter. That was about 2.8% of our lettable area. And we had a positive rental reversion for the quarter of 0.8%. Looking at our acquisitions, I spoke about our 560 million portfolio acquisition. And from a capital management viewpoint, year to date, we've financed 540 million Sing dollars of debt And as I spoke to, also our bond issuance of 150 million SIG. That was for a 7-year term at a fixed coupon of 2.18%. So move on to the next slide. I might hand over to Tricia, who's the head of our capital markets and treasury, just to talk through some of the key credit metrics.
Thanks, Rob. So on the aggregate leverage, it has been mentioned 36.4%. So there's still a healthy percentage. And this is post the acquisition of the 6 European assets that Rob spoke about. In terms of our cost of borrowings, we are at a 1.7% on the trailing 12 months average basis. On our average weighted debt maturity, we are at 3.1 years. So subsequent to the 150 million note issuance that Rob spoke about, we are about 3.4 years now. In terms of our percentage of borrowings at fixed rates, we are at 69.4%. Interest coverage, we are also at a healthy 7.0 times. In terms of our debt headroom to the MAS limit of 50%, we still have about 1.9 billion to go before we hit that limit. And we are actually rated by S&P at an investment grade rating of BBB+ stable. Just looking on the column chart on the right, so our year end is actually 30th September 2021, the coming one. And so you can see that that 235 million that's still outstanding for the 3 months to the year end, that actually has all been either refinanced or we have already put in place the financing facilities to refinance the borrowings. And then if you look at FY22 and 23, we actually the levels of borrowings that we need to refi is very manageable. Yep, back to you, Rob.
Thanks, Tricia. From a portfolio overview viewpoint, you can see how our portfolio is broken down both by asset type and geography. About 58% of our portfolio is logistics and industrial. Another 23% is office and 23% is office and business parks, and then just under 20% is CBD commercial. Australia is certainly still our largest market, with 43% of our assets by value, followed by Germany at 22%, Singapore just under 19%, and the UK just over 11%. So we have 95 logistics and industrial properties, 8 commercial, 4 billion approximately logistics and industrial properties. And you can see that the WALE typically is longer for our logistics and industrial properties, with commercial having a WALE of 4.1 years, logistics and industrial 5.1. We tend to find in Singapore a number of our leases, particularly are around about 3 years. Our industrial portfolio is 100% occupied and commercial just under 92%. I spoke about the leasing earlier and the fact that we did about 75,000 square metres of leasing. This slide gives you a breakdown as to where the deals were done and essentially where the reversions were. We did have a positive 0.8% rental reversion for the third quarter. You will notice though on this, in the table in the top right-hand corner, that we had a negative reversion of negative 3.3% for our Australian logistics assets. I must point out with those properties that they actually enjoy on average 3.1% annual increases. So when we do have a negative reversion of, in this case, negative 3.3%, that's typically not reverting below where the lease started, but it's reversion against where the rent was in the final year of the lease. So we are still seeing market rental growth in those markets over the term of that lease. Pleasingly as well, you can see in Singapore, where we did 14 leases, we had a positive reversion of 4%. Now, the bulk of that positive reversion, though, is Alexandra Technopark. That's the business park property that we have. And we do find that the leases there are certainly well positioned for rental growth. And there certainly is pretty good demand at the moment for space in that building. So if we look at our lease expiry profile. This is a chart that we look at quite regularly. The team that are managing our assets are very focused on those lease expiries in September of the year ending September 22, 23, and obviously the leases expiring in this financial year. It's a good spread expiry profile. We'd like to push 23 back if we could, but certainly the team is seeing quite good renewals at the moment for our industrial stock. Industrial market is performing quite well. And in this financial year, which has really got 3 months to go, we only have 3 industrial and 18 commercial leases expiring for the quarter. And that not one of those leases represents more than 0.3% of our gross revenue. This slide here gives you a breakdown as to our occupancy. As I said earlier, our industrial portfolio is actually 100% occupied. From a commercial viewpoint, given the pandemic, there's been more stress on the commercial assets. Cross-strait exchange currently sits at 84%. There is a slight improvement there from the previous quarter, but really we're seeing pressure more so on a property like that on the retail component, which is obviously not being helped by the restrictions that Singapore has endured. Central Park in Perth at 82.3% is a property that we are focused on. Perth market is improving. We are seeing some more inquiry coming from occupiers, more so for a building of this calibre. It's occupiers of a professional services nature, servicing a lot of the mining companies. And Farnborough Business Park is the other property that we are currently focused on. It has had one of the major tenants hand back some of its space, although we are starting to see some more activity come back to that property as the UK opens up. And finally, I might just talk to Blythe Valley Park. This is our most recent acquisition. I must point out that although the occupancy has gone down from 95.7% to 90.5% as at 30 June, that is more so as a result of a couple of known tenants that were going to break their leases. We do have a rental guarantee over the vacant space in that building, and we actually have been able to secure a number of leases already over some of that vacant space. Just to give you a flavour of the diversification of FLCT, you can see that the top 10 tenants here represent about 23.5% of our total income. So there is good diversification across the tenant base. There's no great reliance on one particular tenant. In fact, if you look at, say, the top 4 tenants here, they're all well-known names. The Commonwealth of Australia is our largest tenant. They represent less than 5% of our gross revenue. They're in our Canberra property. Google Asia Pacific at Alexandra Technopark. Hermes Germany is a very large third-party logistics provider in Europe, as well as Rio Tinto, which is an ASX 10 listed company as well. Taking a closer look at the tenants again, and this is the tenant sector breakdown. So this is the exposure that we have across our tenant base. You can see, I suppose, not unsurprisingly, given our weighting towards industrial, that a big component of the income actually does come from L&I tenants, logistics and industrial tenants, and more so third-party logistics providers, as well as consumer and retail products. And really, consumer and retail products means that the lease is directly with that service provider, with that supplier, and they actually occupy the warehouse. But there is also a good mix across our tenant base, and certainly good exposure to government tenants, new economy tenants, and core and resilient industries as well. We think it's important to talk to the market in relation to COVID and what we're seeing on the ground in relation to our portfolio. I think it's fair to say that year to date hasn't really been a material impact on FLCT's distributable income. It's really, for the 9-month period to 30 June, the impact's been about 1.1 million Sing dollars, and that's been in the way of rental waivers and allowances for doubtful receivables. But really looking at our industrial portfolio, all of our industrial properties have continued to operate in all the markets that we're in, notwithstanding restrictions and lockdowns that may occur. And our portfolio, as I said earlier, remains 100% occupied. Really, the impact that we're seeing in our portfolio is more so coming from the retail tenants that we have at the base of our office towers. And more particularly, it's the retail tenants at the base of 357 Collins Street, as well as the tenants that we have at Cross Street Exchange. But we did an analysis of our retail tenants, and the retail revenue that we generate represents only about 1.6% of our overall income. So the theme that we've seen with our portfolio during this challenging pandemic period has really been one of resilience. And we've certainly seen our industrial occupiers, as Geoff touched on earlier, are actually in some way benefiting from the pandemic through increased volumes in online sales, which has led through to greater requirements for stock, as well as the requirement in markets like Australia for onshoring of goods, which means there is a requirement to hold more stock actually onshore in Australia as well. So really, this slide here is just a snapshot of our competitive advantages that we see for FLCT. Our overall objective is to deliver stable and regular distributions to our unit holders and achieve sustainable long-term growth in DPU. We see our advantages as being the fact that we've got a modern portfolio that's diversified both across asset class as well as geographies. It's got a long WALE, it's well diversified tenant base, and it's very well occupied. You can see, as Tricia spoke to, that we've got a strong balance sheet as well. Our team is very adept at undertaking portfolio accretive acquisitions and recycling our assets when possible at premiums to book value. We've got certainly strong support from our sponsor, who has certainly been a major pull for acquisitions from us, and we've got a green portfolio as well. So those advantages, I suppose, are encapsulated in this table here, showing that we're looking to undertake active asset management. We will look to continue to grow through acquisitions, either through our sponsor, or through third-party acquisitions. We'll continue to manage our balance sheet well and look at efficient forms of financing. And one thing that's also important is that we will look to undertake selective development, most likely with our sponsor, and try to incorporate within those developments sustainability type initiatives, because we can see the benefits not only for ourselves, but also for our customers, being our tenants as well. So we've got now just a few slides on the market. I won't spend too much time on these because I know that the clock is ticking. I won't talk to the key economic indicators for the major markets, other than to say, really, we still are seeing quite healthy unemployment rates in all of the markets that we're in. Australia did record positive GDP growth for the March quarter. It will be under pressure going forward, given the lockdown that is being endured by both Sydney and Melbourne. But what we are seeing on the ground in relation to our industrial rents is continued growth in all of the major markets that we're in. Supply is higher than the 10-year average from an industrial viewpoint, but that's more so in response to the demand that is out there in the Australian market. From a commercial perspective, I suppose, given the challenging environment, pleasingly, we're seeing rents relatively stable in the two major CBD markets we have in Australia, being Perth and Melbourne. Although I do note there is some more supply coming on, particularly in the Melbourne market. Just briefly going through to Germany and the Netherlands. You can see here that certainly take-up has been quite strong, both in Germany and in the Netherlands for industrial space. And we are certainly seeing very strong investment volumes for stock, with prime yields in Germany at around 3.35% for super prime stock. And we're even seeing record yields in locations like Tilburg in the Netherlands at around 3%. So very strong investor demand, seeking the resilient income that is available from industrial stock in those markets. Briefly onto Singapore, really from a CBD perspective, we are seeing some pressure on CBD rents. You can see here on a chart that's been provided by CBRE that rents are a little bit lower in relation to CBD stock, but pleasingly, business park rents have remained stable. And as I said earlier, and pointing to our leasing slide, we're actually seeing some positive reversions at Alexandra Technopark. The UK is an interesting market. Obviously, the UK was quite impacted by the pandemic with extended lockdowns. However, what we're seeing in the business park market is that rents are holding up. There is a trend towards the business park market. We are seeing larger occupiers look to take up space in those lower density markets. Some would call it the hub and spoke effect. But certainly at this point in time, we are seeing rents hold up. From an investment viewpoint, we are starting to see certainly yields being quite stable, and I would suspect there is the potential there might be some firming as investors seek higher yields outside of the industrial market. So that is our presentation, and I understand I'm handing over to Benjamin now.
Thank you, Mr. Wallace, Ms. Susanna, and Ms. Tricia. We will proceed to the Q&A session. You may post your question in the comment section below, and due to time constraint, we will endeavor to answer them. Can we have the moderator, Mr. Benjamin Goh, Head of Research, SIAS, along with the representative of Frasers Logistics and Commercial Trust to kickstart this session?
Thank you very much, Eugene. Apologies, ladies and gentlemen, there seems to be a problem with my camera. It was on just now, but now I can't turn it on. Okay, hopefully the events management team can help me with this. Oh, there it is. Voila, I am back. All right, thank you very much, Mr. Wallace, for joining us today. It was very interesting to see your presentation. Always good to have updated information from the Chief Exec. Thank you very much. Now, the first question is on the merger that we have, or you had last year between Frasers Logistics and Industrial Trust, as well as Frasers Commercial Trust. So as you mentioned, you now have a portfolio of a total of 103 different types of properties across 5 different countries. The question is, what were the original objectives and synergies that you had hoped to achieve through the merger, and has that been achieved?
Thanks, Benjamin, and thank you for the question. Certainly, it was an interesting time to undertake a merger just on the cusp of a pandemic, but really, I've been asked the question in the past, with the benefit of hindsight, would you have done this again? And the answer very strongly is yes. We have certainly seen benefits of scale. Obviously, with the enlarged vehicle, we've been included in a number of indices, including the Straits Times Index. Certainly, I think from an investor or institutional investor viewpoint, we've seen the benefit of increasing volumes in sales, unit trading each day. And also, I think the diversification across the various markets has put us in good stead. I do certainly see opportunities, continue to see opportunities with the old Frasers Commercial Trust portfolio. In fact, one of their properties has become one of my favourite assets in the portfolio, being Alexandra Technopark. Certainly the property is yielding well at around about 6% odd. It has leased up well. It's been quite resilient in the context of the pandemic. And we also see good opportunities in a number of the other assets as well. So we are also starting to see some synergies and relationships across the tenant base. We do have tenants that are actually both in the logistics portfolio as well as in the commercial portfolio. We'll look to take advantage of even more of that. But overall, I do think that the two asset classes sit quite well. And that has actually been seen with our most recent acquisition in Blythe Valley Park, where we acquired both a business park, which was certainly yielding around about 6% odd, as well as a 100% leased and long lease property being connection to, which is actually part of that business park. So this gives us the opportunity to, I suppose, broaden our spread of acquisition opportunities and growth opportunities and get good diversification across our portfolio as well.
Okay, so sounds like good synergies in the capital market space as well as operationally as well. Okay, I think it's always good to get included in the major index, so that will please the fund managers. The next question that we have is about the expansion plans of Frasers. So you've spoken quite a fair bit about the properties that you have and the maiden acquisition of properties in the UK. Do you have some kind of AUM growth target in mind, something that the investors can look forward to?
To be honest, we don't have an AUM target. We don't want to grow for growth's sake. So every acquisition that we make needs to stand on its own two legs. So really, we will evaluate every property and opportunity that is available to us, both through the sponsor as well as on market, and make a determination as to what's going to work for us, and certainly put FLCT in a better position going forward. So we don't want to actually have growth targets because we think that may actually invite bad behaviour. So if you look at our track record and what we've and how we've grown, what we like to see is we like to be able to tick the boxes in relation to portfolio metrics, hopefully help the WALE, help the occupancy, help the diversification, but also see that acquisition as being accretive as well from a DPU perspective.
Okay, so not growth just for growth's sake, and I suppose that's some of the strategies used by other companies, just by taking on a lot of leverage and just growing, just to make the numbers look nice. Okay, related to that is quite a few, or rather a large significant portion of your property portfolio is overseas, right? In Australia, in Europe, so on and so forth. So what are some of the risk exposures that FLCT has, given that a lot of the properties are overseas?
Well, one of the biggest risks, I suppose, in owning properties overseas is ensuring that you've got people on the ground to manage those properties. So fortunately for us, we and our sponsor have quite large teams in all of the markets that we're in. So importantly, in my mind, property is a local business. You need to have people on the ground talking to the intermediaries and talking to your customers, who are your tenants, and ensuring that they are being hopefully overserviced. So that's the biggest risk I see when managing properties overseas. But obviously there are other risks that come with owning properties overseas and repatriating the income back to say Singapore, and that's obviously exchange rate risks. And we look to hedge our exchange rates as much as we can on a 6-month rolling basis. That doesn't eliminate that risk, but it, I suppose, only cushions it, at least from a short-term perspective. The other risk you have, I suppose, is from a financing viewpoint. Tricia has spoken about that earlier during the presentation, but it's obviously important to have good relationships with the local banks. Once again, having people on the ground in those markets talking to those banks as well, and making sure that you're adhering to the requirements that the lenders will have.
Okay. We have another question regarding the leases, specifically the leases which are about to expire perhaps in the next 1 year or 18 months. So the question is, have the negotiations for those leases started? Are they confirmed? Do you see a lot of, or rather a higher uptick of attrition or change, with regards to your tenant base?
It's really a business as usual proposition at the moment. I don't think there are any more challenges in the next 12 months than we've had in the previous 12 months. You can see from our statistics that industrial is obviously leased quite well. There's good demand in all of the markets that we're in from an occupancy viewpoint at this point in time. We've got about 10% of the portfolio expiring in the next 12 months or so. That's, in my mind, no different from where we normally are this time last year. We haven't really seen much downtime between our industrial leases, and I suppose I'm looking at the commercial portfolio, which has been challenged because of work from home directives. But I also see opportunity as people hopefully start to come back, and we can look to lease some of that vacant space that we've got in our commercial properties.
Okay. All right, good to hear. So business as usual, COVID-19 not having a huge impact. That's always, foremost on the minds of a REIT investor. Okay, a slightly different question here. So REITs at FLCT is no different. You are undertaking not just an expansion strategy, but also redeveloping some of your properties. What would be the trade-offs between redeveloping an existing property that you have in your portfolio versus the sustainability efforts and initiatives that that is very much in play in the mass media these days?
Well, hopefully you can do both when you're redeveloping the property. So I would have thought that any property that we would look to redevelop, we would hopefully replace it with an even greener property, taking advantage of, from an industrial viewpoint, solar PV, obviously LED lighting, rainwater reticulation, which is collecting the rainwater, and obviously trying to build those buildings through as much as you can environmentally friendly materials. So I don't think that that's really going to be a consideration that's going to stop us from doing redevelopment. I think other considerations come into place when you look at a property, is looking at what returns you're generating now and what is the trade-off from redeveloping and the returns you generate from that. We do have some opportunities with some of our stock where we've actually just got development land, particularly in our business parks in the UK, where we can actually look to just develop those in any case. So there's essentially no trade-off through developing the vacant land.
Okay. So those would be the flexibility that you can get from a greenfields project. So it's completely new and you can design and build it in. All right, sounds good. And I do have one last question coming in from the social media. Okay, regarding the $5 billion pipeline of properties coming from the sponsor, is there a definite timeline for injecting these into the REIT, so that investors can get some idea of when the property portfolio of FLCT may change?
there's not really a definite timeline because we have a ROFA, which is a right of first refusal over those assets, but it's got to obviously be a willing buyer as well as a willing seller. So it's got to work for both the sponsor as well as ourselves. So once again, as I said earlier in one of your earlier questions, we don't like to have growth targets per se. We really like to look at their portfolio, see what they're willing to deal on with us and see if we can get a portfolio that can work, as well as look at not only the stock that they own, but the stock that they're developing. Both in Germany and more so in Australia, they are quite significant developers. So it's about the stock that they're going to build as well as the stock that they own. And just to add on to that, also looking at third-party acquisitions.
Okay. All right. That is all. Those are all the questions that we have, and I think we are doing very well on time. Thank you very much, Mr. Wallace, for answering all our questions. And Eugene, I'm going to hand over the time to you so that you can do the closing slides and let any of our viewers know if any kind of information, with any kind of information that you like to pass over.
Thanks, Ben, and fellow panelists for being with us this afternoon. We have come to the end of today's webinar. It has been a pleasure to have you with us today. In case you miss any part of today's session, you can rewatch the webinar on SIAS Facebook page. Do like our page and check out our Facebook and our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great day ahead.
Thanks, everyone.
Thank you very much.